Now, let's take a look at these. Basic concept behind this trade, and I know that most understand this who've done these before. As a company is going to have earnings coming up, the fear, uncertainty, and the doubt represented by the earnings announcement increases the implied volatility in the options. What I mean by that, if you're a person who is writing options, and remember the options writers are typically the ones who are driving where the price is at. They're the ones who are saying, I'm creating the availability of these options, and this is the price I'm willing to sell you this option at. So those are the people who are driving the price. As they get closer and closer to an earnings announcement, they stand a risk of holding an option, basically selling an option to somebody that could go radically against them over the earnings announcement. Now, a lot of people are going to be, shifting around positions and protecting themselves, obviously, but these guys don't want to take that risk. So what they do is, as they get closer and closer to the earnings announcement, they raise their prices. They increase the cost of the option that you want to buy. That, in turn, means that the implied volatility in the option series has gone up. Now let's take a quick look at that. Hey, John, if you don't mind muting for a second, you can hear you scuffling.
Just did mute.
There. Thanks. I'm not trying to kick you off.
On.
Yeah, feel free to jump in at any time. I'm not trying to kick you off. I just had...
I've got a new trade out on Scripps, a bull put. Just put it on. ESRX.
ESRX, okay. Okay. This is KMX. Now, as I was talking about a few minutes ago, as the earnings announcement approaches, the earnings announcement approaches, the implied volatility in general tends to go up. So what you're looking at right here is, oh, and by the way, for anybody who'd like to follow along, that is the website that you can use. That's the link you can use to get to this analysis that I've got right here. For anybody who hasn't seen this before, this is an analysis that I did to basically capture money on trades, capture money on trades going into earnings announcements. I went through the historical earnings announcements that the companies had, all the way back, in this case, Q1 2008 through Q1 2012, analyzed all of those, and I looked at how the implied volatility on the options changed as you got closer and closer to the earnings announcement. Each one of these individual squiggly lines represents one instance in the past of an earnings announcement. I basically said that the earnings announcement was on this point in time, the zero line, and I went back 25 business days, took a sample of the implied volatility, and then I measured how that implied volatility changed as it came into the earnings. In the case of KMX, on average, and this is across all of these different earnings events in the past, on average the implied volatility went up 21.32%. That's on average. That's the black line. The key point to this is that a lot of times the implied volatility moved up quite a bit in the last 7 to 10 business days, trading days, before the earnings announcement happened. Now, how do we trade this? Well, we want to create a trade that's long vega, that's long implied volatility, and we want to create a trade that's relatively safe to take. Okay, Jennifer, the number of days shown on the calendar are trading days. So that has to be actual trading days. So it does become a bit of a pain in the butt because you have to subtract out weekends. On this spreadsheet, which I'll have Doug post up after the class, it's not a fancy spreadsheet. It's just, just very basic. It actually calculates out trading days for you. That formula right there will get you the number of trading days between now and the earnings announcement itself. So once again, the key is that we've got this increase in implied volatility. Now, this doesn't tell us anything about anything else going on in the stock. It doesn't tell us that the price of the stock is moving. Doesn't tell us that doesn't really tell us anything except for the implied volatility going up. Now, what do we want to do to take advantage of that? The most basic trade that we can use to take advantage of that, and there are other trades that we could do, but the most basic one is to do a basic straddle or strangle. You take it by a long call and a long put. If it's a straddle, the long call and the long put are typically at the same price, normally the at-the-money strike. If it's a strangle, you take and you move out a little bit. You buy a long call that's a little bit out of the money and a long put that's a little bit out of the money also. By going further out of the money, you reduce the cost of the trade and you actually leverage up the trade a little bit. But there are some things that are negative about that too. So we want to watch that. Straddle is the most conservative version of this trade. The strangles, as you get further and further out, are a little bit more aggressive, but also you need the greater price movements for them to work out better. Well, I'll show you that in just a second. Now, the worst thing about a straddle or a strangle, they're very, very safe trades. In some ways, they're very conservative trades, except for the fact that they have a lot of theta erosion. Now, you're holding two long positions, a long call and a long put. Every day you hold on to that, you're going to lose money. It's just a natural fact. The value of those options goes down. So we want to try to engineer a situation where we lose the least amount of money, and we also want to take and make sure that this implied volatility as it goes up is going to cover our costs on losing the money because of theta. John, did you have something?
Doug, John.
Yes.
I'm going to be off for about 45 minutes, 45 minutes. Bye.
Okay. We'll see you back. So, the goal is engineer a trade that takes advantage of the increase in implied volatility, offsets our theta erosion, which basically gives us what we'd call a free ride in a trade. Now, we can actually have a trade that has very little risk, not no risk. There's still plenty of risks out there, but very little risk relative to the trade itself, and gives us the opportunity to take advantage of big price movements to make some serious money. We've done a great job in this in the past. Google has been a huge winner for us many, many times. A lot of these other stocks have been, good winners for us. And right now, we've actually got a unique situation where this could be a very, very good season for this. The reason for that is that implied volatility is already low. If you've already got implied volatility low, the second biggest risk in this trade, which is the implied volatility going down instead of going up like you expect it, is really mitigated. That risk becomes very small because if there's a channel, there's a bottom to implied volatility. Now, nothing's saying that the market can't be irrational and go even lower than that, but it's unlikely. So this earnings season could theoretically be a very good one for us. KMX is one of the trades that I'm looking at. Now, KMX has its earnings announcement coming up on the 5th of April. So we don't have many days. We have 7 trading days before this thing expires. So we're basically trading from here to here, which is not a bad place to be. That's actually a really nice piece of the slope. We can do a short-term trade, and we have a couple of options as to how we set this trade up. So let's take an actual look at KMX. Now, actually, before we dive into that, I do want to show off a couple of the little pieces on this website itself. This website needs some updating. I've got some new plan changes, but it does have a couple of things that are fairly handy. One is the trade analysis. Now, I told you that the simplest way, most straightforward way of taking advantage of this trade was a straddle. You basically buy an at-the-money put and call, and use that to capture the implied volatility as it goes up. So I did an analysis that basically simulated that. It went back in time, and for every earnings announcement, it created a simulated at-the-money put and call. Started with one 25 days out, and then exited 24 days out. Started with another one 25 days out, exited 21 days, 20 days, 19 days, all the way right up to the earnings announcement itself. These balls, these dots, give you an idea of what the return would be if you had entered a trade at this point and then exited at any point along the line. So in this particular, let's see, let's use this one right here. This trade was entered 20 days before the earnings announcement and exited the day before the earnings announcement itself. And it had an average return across all of the earnings announcements of 20%, or excuse me, 29% return. Now this is the least leveraged of the trades, the straddle. And the green dots represent positive average returns. The red dots show negative average returns. So in this case, if you had have entered in, let's see, 23 days, exited 19 days, on average you would have lost 12%. Now that could have been, a bunch of small loss, or it could have been one big loss, I don't know. Now, what I don't want people doing is using this chart as a absolute perfect, this is the exact point that we want to do this. I want people to look at it and say, this is an area of entry that looks like a good mix. I want to see lots of possible wins here. Because there is nothing perfect about this. When you're analyzing the past, you're analyzing events that have already happened, and you don't have much context. This is just showing you a very, very generalization, a big generalization of it. But what it does tell you is it gives you a sense of what time periods in general work better. So the fact that there's a whole nice area of green here is a positive thing for me to see that. So just some thoughts on that. One more, company profile. Now, what the company profile does is it shows you all of the information relative to all of the other stocks that I analyzed. There's roughly 800 stocks in this database that I've gone through and analyzed. And every one of them has some ratios and some information. Like, when I do the simulated trades, the back testing, I get a ratio of winning trades, which is basically any trade that made more than zero, to losing trades, any trade that lost money. So my ratio of winners to losers is right here. In this case, on this particular stock, 50% of the trades were winners. I also know what the average winning percentage is. I know that on average, my winners are 28.87% return. On average, my losers are 16.20% return, or negative 16% return. So my win return versus loss return is just a ratio is 1.72. My winners tend to be 1.72 times the size of my losers, and I win roughly 50% of the time. I take those numbers and these two charts over here, I compare KMX, CarMax, to every other stock that I analyzed in the database. And you can see that KMX comes out pretty well. The further to the right, the better. And you can see this distribution of samples. It shows you, this right here is the peak, where most of the largest number of stocks that I analyzed ended up in this peak. To the right of this is better. The further you get to the right, the better the analysis was. Same thing over here, average winner to average loser. The average was somewhere slightly above 1.4 right around 1.4, 1.5. KMX with a 1.72 was significantly better than the average. It was on the far right-hand side. Just some ways to take a look at these. Just some thoughts to that particular stock. Now we'll take a look at a couple others here in just a second, but okay. All right, let me pull this off. Let's take a look at KMX right now. Okay, Mike. Okay, actually, Dennis and Mike. First of all, the number of trades on KMX, yes, the trades analyzed of 5,400 was actually trades on KMX, not on all 800. This database is, God, it's on average right now we have somewhere around 5,000 trades analyzed per symbol across 800 stocks. So it analyzed 4 million separate trades across the entire database. KMX represents 5,400 of those. Now that 4 million is a rough number, but it's pretty accurate. Now, Mike, to clarify, if a stock reports earnings just after the close, it's that counts as day zero. If it's before the open, you have to make a slight adjustment and go back one day. There's so many variables in here that I didn't nail down every single thing. You still have to use a little bit of judgment when you're looking at this. One of the things that you don't want to do on this particular trade, we have another trade to take advantage of this, but on this trade, you do not want to be holding a long straddle or strangle after the earnings announcement, because the implied volatility is going to drop like crazy. You can see it going from here down to here. In this particular case, it's up 21.32% at its peak. The day after, or literally the moments after the earnings announcement happens, the implied volatility drops to negative 3% relative to where it started. So you can see that that's really a big drop. You need to avoid that. This tool, this website that I'm giving you, is just something to help you on the trade. It doesn't tell you everything. You still need to work out the details. So Mike, did that answer your question? And actually, Dennis, same question. Okay. Now, KMX. And by the way, we're going to get into Google here in just a second. Google's another very good one. KMX has had a pretty good price movement recently. The implied volatility is starting to go up. Now, by the way, ignore this V-shaped drop down here. That was just TradeStation screwing up the data. The implied volatility did not go to zero on that day.